Hi, this is Laura with Group 1, and we are here to discuss the acquisition of 21st Century Fox by Disney. Let's begin by discussing the history of Walt Disney. They originally began in 1923 as Disney Brothers Cartoon Studio. This was started by Walt and his brother Roy. Once the studio was complete in 1926, the company changed its name to Walt Disney Studio. After this, Disney ventured into television and in the 1950s and in 1955 started the Mickey Mouse Club. Before this, however, they aired Disneyland Anthology series, which ran for 29 years. To this day, it marks it as the longest-running primetime television show. Along with these shows, Walt decided to also start their first amusement park. Disney has been acquiring companies since 1957. These acquisitions include Western Publishing and Walt Disney making Disney majority owner. Once they acquired American Broadcasting Paramount Theaters, they became sole owners. In 2001, they acquired Fox Family Worldwide, followed in 2004 by The Muppets. This began letting them expand their target market. They continued to expand their market by acquiring Pixar in 2006, Marvel in 2009, and Lucasfilm in 2012. They then decided they wanted to start their own streaming platform called Disney Plus. To do this, in 2017, they acquired Famtech, and 2 years later, in 2019, they acquired 21st Century Fox. This gave them the ability to add even more shows to their streaming platform. So why did Disney want to purchase 21st Century Fox? Disney wanted to join the trend of streaming so that their market would come to them rather than paying other companies to watch their shows or movies that they produced or owned. Currently, Disney is honoring their contracts with Netflix as they still have current and future streaming rights to specific shows and movies. 21st Century Fox was the last acquisition they felt was needed in order to go live with Disney Plus. This was their second largest paid acquisition that Disney was associated with. So why did 21st Century Fox sell? Essentially, Disney gave 21st Century an offer they couldn't refuse, with an offer of $71.3 billion. This was not all in cash, but also included shares. These company shares gave 21st Century owners approximately 19% non-controlling interest into Disney as a company. Also, Disney and 21st Century Fox have similar investments. One of the investments included in this group is Hulu. Once the deal was done, Disney would have majority control over many of these investments. This let 21st Century owners stay in the business and reap the profits if this acquisition was successful. So how successful was the merger to get Disney Plus up and running? Disney Plus is now 1 year old and has 73.7 million subscribers. The CEO has recently stated the results are far surpassing expectations in just the first year.
Hey, this is the segment where we're going to go over the issues that we're going to be looking at with the merger, and later in the presentation we'll go over how Disney sort of handled these issues or how well they dealt with them during the process. So the first issue we had is that Disney needed to acquire more content for their Disney Plus service, and that's a fairly straightforward one. They just in order to compete with companies like Netflix or whatever, you need to have a lot of stuff for people to watch. So Disney needed to add things for that. And then the second issue is that Disney had existing contracts with Netflix that could cause conflicts with their new service. And, Disney didn't have their whole library on Netflix, but they had quite a few shows. And acquiring the rights to all these shows could prove to be really costly and time consuming, especially when everything has its own licensing agreement with specific terms and they're negotiated at different times. It can become a mess, really quickly. And then the third issue is that Disney wanted to expand horizontally when acquiring 20th Century Fox. So yeah, they were just sort of trying to broaden themselves with the acquisition, and we'll look at whether they were able to accomplish that with it or not. And the fourth issue is that Disney wanted to acquire Hulu to broaden their subscription video on demand, or SVOD, reach. And like it says down there, 20th Century Fox owned 30% of Hulu before the merger, and Disney owned another 30%. So, their plan was to sort of, by buying out Fox, it would have 60% and be able to gain a controlling interest in the company based off of that. So now we're going to move on to the analysis of the merger. So stay tuned.
For my portion of the project, I'm covering accounting rules and policies. Principles of consolidation. The consolidated financial statements of the company include the accounts of the Walt Disney Company and its majority-owned or controlled subsidiaries. This now includes 21st Century Fox and Hulu. Because of the acquisition of the 21st Century Fox, Disney gained an additional 30% share in Hulu, which brings its shares to 60%, thus giving Disney a controlling interest in Hulu. Intercompany accounts and transactions have been eliminated from the consolidated financial statements. The company enters into relationships or investments with other entities that may be variable interest entities. A variable interest entity is consolidated in the financial statements if the company has the power to direct activities that most significantly impact the economic performance of the variable interest entity, and has the obligation to absorb losses or the right to receive benefits from the variable interest entity that could potentially be significant, and this is defined by ASC 810-10-25-38. Under revenue recognition, revenue is recognized when the control of the services or products is transferred to the customer. The company has 4 broad categories of service revenues. One of those categories is licenses of rights to the use of intellectual property. One form of intellectual property is called functional IP. Revenue related to the license of functional IP is generally recognized upon delivery or availability of the intellectual property to the customer. Detailed examples of the revenue recognition policies for our key revenue are affiliate fees, subscription fees, and TV straight-to-video distribution licenses. Film and television costs. The costs of television broadcast rights for acquired series, movies, and other programs are expensed on an accelerated or straight-line basis over the useful life or over the number of times the program is expected to be aired as appropriate. Individual programs are written off when there are no plans to air or sublicense the program. The cost of film and television series that are used by the direct-to customer services are expensed based on historical and estimated viewing patterns, which may be on an accelerated or straight-line basis as appropriate. The unamortized costs are reviewed for impairment on an aggregate basis for each service. Goodwill, other intangible assets, and long-lived assets. The company is required to test goodwill and other indefinite-lived intangible assets for impairment on an annual basis, and if current events or circumstances require, on an interim basis. Goodwill is allocated to various reporting units. The company compares the fair value of each reporting unit to its carrying amount, and to the extent the carrying amount exceeds the fair value, an impairment of goodwill is recognized for the excess up to the amount of goodwill allocated to the reporting unit. Generally, Disney uses a present value technique or discounted cash flows corroborated by market multiples when available and as appropriate. Disney applies what they believe to be the most appropriate valuation methodology for each of their reporting units. The projected cash flows of the reporting units reflects inter-segment revenues and expenses for the sale and use of intellectual property as if it was licensed to an unrelated third party. The company is required to compare the fair values of other indefinite-lived intangible assets to their carrying amounts. If the carrying amount of an indefinite-lived intangible asset exceeds its fair value, an impairment loss is recognized for the excess. Fair values of other indefinite-lived intangible assets are determined based on discounted cash flows or appraised values as appropriate. The company has determined that there are currently no legal, competitive, economic, or other factors that materially limit the useful life of the FCC licenses and trademarks. Amortizable intangible assets are generally amortized on a straight-line basis over periods of up to 40 years. The cost to periodically renew intangible assets are expensed as incurred. The company tests long-lived assets, including amortizable intangible assets, for impairment whenever events or changes in circumstances indicate the carrying amount may not be recoverable. The company tested its goodwill and other indefinite-lived intangible assets, long-lived assets, and investments for impairment and recorded non-cash impairment charges of $538 million, $210 million, and $22 million in fiscal years 2019, 2018, and 2017, respectively. The fiscal 2019 and 2018 impairment charges related to equity investments were recorded in equity in the income loss of investees net. In the consolidated statements of income, the fiscal 2017 impairment charges were recorded in restructuring and impairment charges in the consolidated statements of income. And earnings per share. The company presents both basic and diluted earnings per share amounts. Basic EPS is calculated by dividing net income attributable to Disney by the weighted average number of common shares outstanding during the year. Diluted EPS is based upon the weighted average number of common and common equivalent shares outstanding during the year, which is calculated using the treasury stock method for equity-based awards. Common equivalent shares are excluded from the computation in periods for which they have an anti-dilutive effect. Stock options for which the exercise price exceeds the average market price over the period are anti-dilutive and accordingly are excluded from the calculation. New accounting procurements. New accounting procurements were adopted in fiscal year 2019. Accounting procurements that were adopted were revenues from contracts with customers, that is referenced in Note 3 of the 10K, intra-entity transfers of assets other than inventory, referenced in Note 10 of the 10K, improving the presentation of net periodic pension cost and net periodic post-retirement benefit costs is in Note 11 of the 10K. Reclassification of certain tax effects from accumulated other comprehensive income is referenced in Note 12 of the 10K. Recognition and measurement of financial assets and liabilities is referenced in Note 12 of the 10K. And targeted improvements to accounting for hedge activities. The adoption of the new guidance did not have a material impact on the consolidated financial statement. Leases. In February 2016, the FASB issued new lease accounting guidance, which requires the present value of committed operating lease payments to be recorded as right-of-use lease assets and lease liabilities on the balance sheet. The guidance is effective at the beginning of the company's 2020 fiscal year. The company estimates the adoption of new guidance will result in the recognition of right-of-use assets and lease liabilities for the operating leases of approximately $4 billion. Additionally, the company will reclassify a deferred gain of approximately $350 million related to prior sale leaseback transactions to retain earnings upon adoption, and improvements to accounting for cost of films and license agreements for program materials. In March 2019, FASB updated guidance for the accounting for film and television content costs. The new guidance impacts the capitalization, amortization, and impairment of these costs as follows. It eliminates the limitation on capitalization of production costs for episodic content, aligning the capitalization model with film content. It requires production costs that are being amortized based on estimated usage to be reviewed and updated each reporting period, with any changes in estimated use applied prospectively. And it requires produced and acquired programming costs to be tested for impairment using lowest level of identifiable cash flows based on the predominant monetization strategy for the content. For example, monetized individually or in a group. The company currently does not expect the new guidance will have a material impact on the financial statements. The guidance is effective at the beginning of the company's 2021 fiscal year, with early adoption permitted, and requires prospective adoption. The company plans to adopt the new guidance in fiscal 2020.
Hi everybody, my name is Patrick Boyd and I'll be discussing the application or analysis of the acquisition of 21st Century Fox by Disney that occurred in March 20th of 2019. Here I'm showing there was a few challenges that Disney needed to overcome to be successful in their acquisition, starting with meeting DOJ regulatory requirements, completing SEC filings, and meeting SEC regulatory requirements. They also had faced competition from competing bids. They had to overcome the intricacies of combining corporate functions. They had to work hard to try and achieve the synergies that they had hoped for in a timely manner, and while maintaining current agreements and moving forward with creating new agreements. And of course, always integrating of administrative and technology functions is a challenge for everyone. So part of the FCC regulatory requirements actually forced Fox to spin off a brand new Fox Corp that would carry the Fox television stations, Fox News Channel, and Fox businesses, and also some of the Fox sports channels as the FS1, FS2, Deportes, and Big Ten Network. And this is all due to the dual television network ownership rule that says that none of the big four are allowed to combine because it would be too much like a monopoly. And so with Disney owning ABC and 21st Century Fox owning Fox, that's what forced this spin-off. As part of that spin-off, I'm showing here the Q1 10Q report for the new Fox Corporation to kind of show you what monetarily what kind of assets were actually peeled off as part of that spin-off. And they actually took a pretty significant chunk here. It was about $13.5 billion in total assets came with the new Fox Corp. So this was a significant event for 21st Century Fox and for Disney that happened to spin that group off. I discussed earlier that one of the challenges was competition. So Disney had originally reached an agreement with Fox to acquire them for $52.4 billion. But then Comcast came in and raised the bid to $65 billion. And then Disney finally had to counter with $71.3 billion, which of course in my mind is a huge sum, to win the bid. But consequently, since it was raised so high, Disney now had to take two loans to meet cash requirements for the acquisition, that totaling $31.1 billion. And both of these loans were 364-day unsecured, short-term unsecured bridge loans that they did, in fact, pay off within the 1-year timeline. So in any acquisition where the acquiring company is paying more than market value fair market value for the company they're purchasing, there's going to be an overage, and we have to account for that overage as goodwill. Normally we would calculate goodwill as taking the difference between the net identifiable assets of the company being purchased and the amount that was paid for that company. And so in this case, we had a final purchase price from Disney, as shown in their 10K, to be $69.5 billion approximately. And I could not find the correct S4 document that showed what the actual fair value at the time of purchase was for 21st Century Fox, so I had to do kind of a back of the napkin calculation based off of their Q1 10Q report. And so I came up with approximately total assets reported being the 65.9 billion dollars here, minus their total liabilities of approximately $32.2 billion, and leaving our identifiable assets at $32.65 billion dollars. And so when I did the math on that, I came up with a goodwill that should have been accounted for at roughly pretty close to $37 billion. Now, when I go back to the 10K form, Disney's 10K form that accounts for this actual purchase, I see that they actually recorded $43.7 billion here, leaving me a little pretty short here, right? $6.9 billion that I missed somehow. I'm not exactly sure where the extra came from. I mean, obviously I made a mistake, but I also do kind of wonder if this is attributable somehow to the gaining here we go. And here you can see the excerpt from the 10K that shows exactly how the costs were allocated throughout the purchase. And that's it for me. Thanks.
Alright, and now to wrap the presentation up, we're going to go over the conclusions that we came up with after looking at the issues and the analysis. So the first issue that we discussed is that Disney needed to acquire more content for their Disney Plus streaming service, and this one is fairly straightforward. Just by purchasing 20th Century Fox, they got access to their vast content library. And Disney added a ton of shows to their catalog in doing that. So this allowed them to get things like just like all of Fox's content. And as we'll go into later, Fox also had a controlling interest in Hulu that a non-controlling interest in Hulu that became a controlling interest once they added Disney's share to it. And the second issue that Disney had is that they had some existing contracts with Netflix to like host some of their films and series on their service, which could cause issues because Netflix had like exclusivity deals signed for that, so they couldn't run the content on both services. And so according to the research that I did, Disney lost about $150 million to sort of buy out those contracts when they cut ties with Netflix. But to be frank, $150 million for a company like Disney isn't a lot, and they deemed it a viable expense to sort of just pay this big cost up front. And because that Netflix doesn't own any like conflicting contracts with Disney anymore, so they're able to just throw their library up there as they wish. And yeah, looking at the financial data, what that Disney Plus has made in this first year-ish of being up, they've totally made that money back and more. So that was a good play by them. So the third thing that we looked at is how Disney wanted to expand horizontally when acquiring 20th Century Fox. So Disney, they wanted to sort of expand their production of television shows and streaming entertainment, and 20th Century Fox is massive. I mean, that they own, some huge franchises. They have a lot of like network television marketing too, which Disney kind of has, but nowhere near to the extent that 20th Century Fox does. So in terms of like just sort of building their market presence, Disney did a good job of doing that by acquiring Fox and sort of adding their entire catalog to Disney Plus. And then for the final bit, I sort of mentioned this earlier, that Disney wanted to acquire Hulu in order to broaden their SVOD, that's subscription video on demand reach. And so basically before this, Disney had a 30% ownership of Hulu at the time, and 20th Century Fox also owned 30%. I believe that the rest of the stake was owned by Comcast, and there's another partner who owned 10% at the time. But because Disney and 20th Century Fox owned 30% each, this sort of gave them a controlling interest in the company, so they're able to, sort of take control of Hulu, and they've used that really well to help expand their catalog. And I guess the main conclusion that you can draw from this was that acquiring 20th Century Fox was absolutely a great business decision for them. The buyout upfront seemed very expensive, but looking at the revenues that Disney's been making, it seems like the decision definitely paid off for them in the long run. I don't at least see anything that indicates that it was bad for them. And then here's the sources for this conclusions part. Just a few articles that I grabbed the facts from. And thank you for watching our presentation.